The Long Short Credit Fund is an absolute return fixed income hedge fund that can profit from mispricings through all market cycles, specifically exploiting inefficiencies in assets that are both overvalued and undervalued. It targets returns of about 7 to 9% per annum after fees, or more specifically, approximately 4 to 6% per annum above the neutral RBA cash rate. The central bank says the neutral RBA cash rate is about 3.5%. The Long Short Credit Fund targets volatility of less than 5% per annum. That is around 1/3 the volatility of the Australian share market. Unofficially, we'll be targeting volatility of around 2 to 3% per annum. Smarter Money Investments is the retail investment manager for the Long Short Credit Fund. It outsources all portfolio management duties to Coolabah Capital Investments, as it does with its existing two retail trusts, the Smarter Money Active Cash Strategy and the Smarter Money Higher Income Strategy. SMI and Coolabah run a little over $1.8 billion in Australian cash and Australian credit strategies today. The portfolio management team comprises 7 portfolio managers and analysts.
Our institutional clients ask us to create a product that leverages off our proven 6-year track record for creating alpha in all market conditions, with returns similar to that of the equity market with about 1/3 of the risk. We think there is a missing market for absolute return funds and long-short credit strategies in Australia.
To stress test this strategy, we use the track records of our existing funds back to 2012 and simulated returns back until 2003. This captures the period of 2008-2009 called the GFC. These simulations suggested that the strategy would return annually before fees approximately 11.5% per annum. This compares very well with the equity market return of 8.7% per annum over that period. The volatility of the strategy was 4.9% per annum, which is less than 40% of the 13% per annum volatility of the equity market. The worst drawdown of the strategy was less than 1/3 of that experienced by the equity market during the GFC. These numbers are only simulations and shouldn't be used to make decisions, but they are very encouraging findings.
Our 7-person investment team, including portfolio managers and analysts, use a suite of top-down and bottom-up quantitative models to reprice every asset on a daily basis based on their risk. We then augment this with a rigorous qualitative due diligence process, and as a result we have found that the Australian credit market is quite inefficient and there are ample opportunities for generating alpha.
Our fund is protected by an independent responsible entity, OneVue, an independent administrator, Fund BPO, and 2 independent custodians, one of which is Equity Trustees. In addition to this, we have an independent risk and compliance committee led by Melda Donnelly, Bob Henricks and Alex Wise, with Melda and Bob also on the investment committee. Our risk management systems are second to none. We spend approximately $500,000 a year on this technology alone.